Financial planning for 25 to 40-year-old. Get in the top 1%. See, since 2020, when fintech influencers became famous, the noise in the finance ecosystem has increased so much. Many people keep giving all sorts of random tips. Invest in this meme coin, money will become 10x. Want to do shopping? Do buy now and pay later. Want higher returns than FD? Put it in P2P lending, etc. etc. So, my simple intent with this video is to cut through all that noise and tell you in simple, plain, and easy words what are those 6 to 7 things you need to do that will cover 90% of your financial planning. A framework that will make you stand in that category of the top 1% of people who remain financially secure and stress free. I know no one can make a financial plan for your life in 8 to 10 minutes. So, in this video, we will talk at a very high level. But I promise, if you follow these 6 steps, you will move ahead of 90% of people. So, if you want to move ahead of 99% of people and come into the top 1%, then for whatever point we discuss, we have made detailed videos on all of them. So if you want to go into the depth of any topic, then watch the specific detailed video of that topic. I guarantee you will be in the top 1%. So let's start. Step 1, the foundation, your emergency fund. See, as soon as you start earning and after checking off your wish list, a little bit of money starts getting saved. The very first thought that comes is to invest. But there is a step that comes way before investing: emergency fund planning, because until you don't plan for this, you are just one emergency away from going bankrupt. As per latest reports, 71% of Indians working in companies over hospitals cost out of their own pockets. Just think, if there is even one slightly long hospitalization for you or anyone in your family, then the entire savings of more than 70% of people will go away in one stroke. And this is just about hospitalization. Apart from this, how many other emergencies can happen? Getting fired from a job, car breakdown, some unexpected repair in the house. How big should it be? Experts will say that an emergency fund equals to 6 months of your expenses is enough. But I don't subscribe to this theory. According to me, this answer is a bit misleading. Emergency fund is a part of personal finance because it is personal. This is different for everyone. The amount should be such that it gives you and your family peace of mind. For me, this is a 12-month fund. For you, it might be 9 months. And there is one more nuance in this. Suppose your monthly expense is 50,000. This includes your restaurant bills, shopping, trips, everything. But if you lose your job, will you still do these unnecessary expenses? No. So calculate your emergency fund according to your basic expenses, not total expenses. If in 50,000 expenses your basic needs are met in 30,000, then make your fund by multiplying 30,000. Where to keep it? It is very important to have three things in an emergency fund. First, stability. It should not be volatile. There should be no stress in this. Second is liquidity. It should be immediately available. Third is inflation beating returns. Its value should not decrease with time. This is why equity, mutual funds, and stocks are straight way out. The best approach is a combination: 50 to 60% in a separate saving account with auto sweep enabled. With this, you will get FD like returns and the liquidity of a savings account. 30 to 35% in liquid funds. These are extremely low risk debt funds that can give you close to FD or sometimes better than that. Their volatility is almost zero. 10% in cash or gold coins. This is for that 1% extreme emergency when maybe there is a cyber attack and all banking systems go down. I know it is far fetched, but in emergency planning, thinking of the worst case scenario is necessary. Step 2, the shield, health insurance. Once your emergency fund starts building, the second step is to shield yourself. And the biggest tool for this is health insurance. Many people, especially those in corporate jobs, think my company has given cover. What do I need it for? This is the biggest mistake. Your corporate cover is not enough. What will happen if you switch jobs or if you lose your job? And most importantly, when you retire at the age of 55 to 60, no company will easily give you health insurance then, especially if you have developed any illness. That is why taking a personal health insurance policy is non negotiable. How much cover do you need? Honestly, a cover of 5 to 10 lakhs is old news now. In today's time, the bill for even a half serious illness crosses 5 to 7 lakhs in a metro city. My recommendation: Tier 1 city, minimum cover of rupees 20 to 25 lakh per person. Tier 2 city, minimum cover of rupees 10 to 15 lakh per person. Individual versus family floater. The simple answer is, if everyone in your family is healthy and the age of the eldest member is less than 60, then you can take a family floater. But if there is even one member in the family whose health generally remains not so good, then take a separate individual policy for them and take a floater plan for the remaining members. By doing this, your premium will get optimized. Now, before taking health insurance, you have to look at many factors like claim settlement ratio, network hospitals, co-payments, sub-limits, etc. For this, definitely watch our detailed video. But if you don't have time to watch the detailed video, I will tell you the names of three policies that you can consider. HDFC Ergo Optima, Super Secure, Aditya Birla Active, One Max, and ICICI Lombard Max Protect. Step 3: The Protector Term Insurance. This is one thing that people aged 25 to 35 don't even want to think about, but this is perhaps the most necessary. Term insurance. See, 25 to 40 is that age when most likely you will get married, maybe have kids too, and you will have your own family that will depend on you. In such a situation, having good term insurance becomes quite necessary. And keep this absolutely simple. Do not take any ULIP, any endowment, any mixed plan at all. Just plain and simple, pure term insurance plan whose premium is the lowest and cover is the highest. Ideally, how much cover should you have? A simple thumb rule is 15 to 20 times your annual income. If you earn rupees 10 lakhs a year, then you should take a term plan of at least rupees 1.5 crore to rupees 2 crore. And the most important thing, this is available cheapest only when you are young and healthy. The more you delay, the more expensive it will become. Now, before taking term insurance, you have to look at many things like riders, claim settlements, ratio of the company, policy tenure, and premiums. But again, if you don't have, I will tell you the names of three policies that you can consider. Axis Max Life Smart Term Plan Plus, HDFC Supreme, and ICICI I Protect Smart Plus. Step 3: The Growth Engine. Start investing. Now, when your emergency fund and insurances are sorted, now comes the time to grow money. See, the first golden rule here is to start as early as you can, preferably within the first few months when you start earning a salary, and you should invest at least 25 to 30% of your in hand salary. Every month, as soon as the salary comes, your investment SIPs should get cut automatically. Plan your month with the remaining money. This is called pay yourself first. Okay, we understood how much to invest, but let's understand how to invest. In this, you can use the core satellite approach. Divide your entire investment portfolio in two parts: core and satellite. Core portfolio should be 60 to 70% of your portfolio. This is the foundation of your portfolio. Its job is to give stability and long term consistent growth. In this comes large cap fund. Here you can consider either an equal weighted Nifty 50 index, because 85 to 90% of active large cap funds are not able to beat the index in the long term. So, better than guessing, just invest straight in the index. Flexi cap fund. This gives fund managers the freedom to invest in large, mid, or small caps according to market conditions. Mid cap fund. A little more risk, but potential to give better returns than large cap in the long term. Satellite portfolio could be 30 to 40% of your portfolio. This is the aggressive part of your portfolio whose job is to generate extra returns, alpha. This is a bit risky. In this comes small cap fund, high risk, high return category. International fund, example NASDAQ 100. This gives you geographical diversification. Plus, when the dollar gets strong against the rupee, you get the benefit of that too. In the last 15 years, due to this dollar appreciation, NASDAQ 100 has given far better returns than Nifty 50 in INR terms. Momentum or thematic funds. These are strategies that bet on current market trends. This is high risk reward, and consider this only when you understand it. Achieving a long term average return of 12 to 15% from this portfolio is very possible. Step 4: The aspiration. Real estate. Beta, you must have at least one property. We have all heard this line from our parents and elders, and it is every Indian's dream to buy their own house. Real estate is an asset class that we all are obsessed with. But it is necessary to understand a very important distinction here. Real estate is of two types, one in which you live and the second in which you invest. The way to approach both is completely different. Owning a home to live in, buying your own house in which you will live with your family, this is more of an emotional decision than a financial one. This gives you stability, gives security, and gives a sense of accomplishment. You should not see this as a pure investment. This is a huge life goal, and one should plan to achieve this. When you are 25, you generally don't have clarity on which city you are going to live in. You start getting this clarity only when you're married and have kids. So, I would strongly urge you to postpone this decision until you are married and have kids. If you are thinking of investing in physical real estate just for the sake of investing, there are two very big problems in this. First, real estate has high ticket size. Not everyone can afford 50 lakhs or 1 crore. And for this, you have to take a huge loan, which can derail your other financial goals. Second is illiquidity. You cannot sell real estate whenever you want. It can take months or even years to sell it. The smart alternative, REITs. So, what to do? If you really have to invest in real estate, then a modern smart way for this is REITs, real estate investment trusts. In simple words, when you buy a REIT, you essentially buy a small share in a huge portfolio of commercial properties like malls, office parks. This has two benefits. First, dual income. You get a share of regular rental income as dividends, usually 4 to 7% per year. And capital appreciation also happens when the property value increases. Second is high liquidity. REITs are listed in the stock market. You can buy or sell them anytime like a share. So my advice, the house you want to buy to live in, that is more of an emotional decision than financial. But the property you want to take for investment, delay that until your late 30s. Until then, if you want exposure to real estate, REITs are the best way. Step 5, the responsibility. Will planning. This is another topic hearing which people say, "Oh, what is my age right now anyway?" This is the biggest myth. Will planning is not just for the elderly. Life is unpredictable. A will ensures that after you are gone, all your hard earned assets, your bank balance, MFs, stocks, property go to exactly those people whom you want to give them to without any legal hassle. Often people think that making a nominee is enough, but in legal terms, a nominee is just a custodian. The real owner is the legal heir only. A will ends this confusion forever. Nowadays, with the help of online will making services, making a basic will has become very simple and cheap. It is not about planning for death, it is about being responsible for your family's future. So, see, before looking at the final step, I have a request. Our team works very hard to bring such informative videos for you. If you like the video, then please comment below. This is the best video on financial planning. It gives us a lot of motivation. The final step, review and rebalance. Look, making this plan is not a one time process. You have to maintain it regularly too. Rebalancing. Suppose you decided that you will invest 70% in equity and 30% in debt. After 1 year, because the market did well, it is possible your equity becomes 80% and debt 20%. Rebalancing means once a year selling a little equity and buying debt to bring it back to 70 to 30. With this, your risk remains managed. Review. Your life will change every 1 to 2 years. Your salary will increase, you will get married, you will have kids. This is why it is very important to review your entire financial plan every 1 to 2 years so that it remains aligned with your current life. That's it. If you do all of this, I can guarantee you, if you just follow this framework for the next 10 years, you will be financially far ahead of 99% of the population and well on your way to entering that top 1%. If you like the video, don't forget to comment.